sure Mr. Saff will make a motion to modify the June 24th meeting agenda.
We just have the adjourn and the closed session in the
See,
wrong
number
order.
6 and number 7 need to be,
Switched.
right, because if we adjourned, how could we ever go into closed?
So it's 6 becomes 7.
It should, right.
It's not-
You
no,
need
it's
a
not.
motion?
Yeah.
Mr. Safford will take care of it,
I'll
I think, right?
the appropriate motion.
Thank you.
Going to, they're going to make a motion to change it and then to approve the changed agenda.
You are on.
Oh, okay, I was waiting for the intro. I'm sorry, I didn't see that little green piggy bank or whatever. Thank you. Good afternoon, everybody. David Weiskopf calling to order the Sheriff's Office Retirement Plan Board for Thursday, June 24th, 2021, time 1 p.m. here in the Chesapeake Building in Leonardtown, Maryland. And the first thing I'll do is ask if the board wants to approve the 24 June meeting agenda.
I'd like to make a motion to make a change to this agenda, switch item number 6 to an item number 7.
So that closed session comes before adjourning? Certainly.
That's correct, yep.
Is there a second?
I'll second.
Thank you. Is there a vote? All in favor?
Aye.
Aye. Ayes have it, motion carries. Next is the approval of the April 22nd, 2021 meeting minutes. I'll be glad to entertain a motion once everybody has reviewed it.
Move to approve.
Second.
Have a first and a second. All in favor, say aye.
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 Ayes have it, motion carries. Next is new business, and item A is Patrick Wing of Marquette Associates. Number 1, first quarter 2021 investment performance report. Take it away, sir.
All right, well, thank you, and good afternoon, everyone. So we distributed a packet of books there. The quarterly performance report will be the one on top. So that will be the first item of our discussion in the agenda today. So once you find that book, if you could do me a quick favor and hop behind the cover page there where you see St. Mary's County, the logo, and Sheriff's Office Retirement Fund to the table of contents. So that is before Exhibit 1, right after the cover. Just a quick minute about what we're going to talk about today, because this is the first time we're preparing and presenting our quarterly performance report. At our last quarterly review, we presented the previous advisor's report. So we might spend a little bit more time walking through some of the data and analysis because it'll be new to the board. But if we think about things at a high level here, and as I walk through this table of contents, I'll give you a little bit more information about what we're going to be talking about. Section 1 is just an update on Marquette, our firm. We will rarely, if ever, take a look at that unless there's something relevant for you all to be cognizant of. Where we'll really start is that second section, market environment. So like we did in our previous meeting when we ran through the report, look at the economy, capital markets to provide context for how and why the retirement fund performed the way it did and how and why some of the investment managers performed the way they did. After we do that, we'll get into the portfolio overview, so that will be a look at the fund itself. And there's really 4 main takeaways. We'll look at cash flows, returns, asset allocation, and then also characteristics or exposures themselves, and at a more detailed level. So we'll start with the total fund. We'll look at the asset classes and then the managers themselves. And then the final section is investment managers. We'll rarely, if ever, look at that. What that is just an overview of the holdings, the exposures for the equity managers, the characteristics of the fixed income managers. They're there more for reference in case anyone from the board has a question around any particular manager, then we'll reference it. But we'll rarely, again, if ever, get into that section. So with all that said, if you could please hop behind Exhibit 2, so skip Exhibit 1, again, the Marquette update, and hop behind Exhibit 2 where you see market environment there, and we'll start with the U.S. economy. So this is page 6, where you see U.S. economy at the top left. If you look at the top bullet point on the left there, that first sentence, it was a very strong quarter for economic growth in the U.S. You can see up about 6.5%. To illustrate that, if you look at the top right graph on that same page, we're showing the real economic growth. The bars are the quarterly numbers. The last 3 striped bars are estimates through the remainder of 2021. And then the orange line there is the year-over-year number. But you can see in those last 2 fully colored in bars, which is Q4 of last year and Q1, the acceleration that I talked about. And that was really driven by the themes that we've seen over the past couple quarters: continued strength in consumer spending, continued strength in business investment, really on the back of all the fiscal policy support that we've seen come out of Washington. All the 3 or the 4 packages at this point intended to support consumers, to support businesses amid the pandemic until we can get to the other side, until a fully reopened economy. But if you continue to look at that top right chart and the estimates there in those striped bars, economists are calling for very strong growth to round out the year. And if they come to fruition, it's going to be the strongest calendar year for economic growth since 1984. So about 40 years. So right now we have an economy, it's been supported quite drastically by policy support, the fiscal side. But as that support begins to wane a little bit, the expectation is that the private sector, consumers and businesses, will begin to be able to stand on their own 2 feet as the economy continues to fully reopen in the back half of the year. Now, amid that, the strong economic rebound and that historic support from the fiscal authorities and the Federal Reserve on the monetary side, we've seen some inflation concerns begin to come up to the surface. So we've seen a huge jump in commodity prices. I'm sure you're all well aware of. Food prices have gone up. We've all seen gas prices go up. So inflationary concerns have risen to the forefront and are starting to build a little bit because a lot of the input costs that businesses are sourcing to produce the goods and services for consumers and other businesses, those are rising as well. So we see things like, I'm sure you've all heard of lumber prices going through the roof over the past few months. Electrical wire for those trying to do home improvements have increased dramatically because it's copper-based, and copper prices have gone through the roof. So right now, if we look at that bottom right chart, there's a survey put out by the National Federation of Independent Business asking companies, about 100 or maybe even thousands of companies across the U.S., a series of questions. And 2 of them are simply, are you planning to raise prices or planning to lower them? And that's showing the difference between the 2. And if you look all the way to the right there, those planning to raise prices outnumber those planning to lower them at about a decade high. So we've seen inflation concerns start to build up. We've seen stronger or bigger inflation prints come out. And it seems like the pipeline, if you will, for further inflation, at least through the back half of this year, would seem likely to come to fruition based on where things stand with those rising commodity prices, those rising input prices. So that's a short-term look at inflation, and I'll talk about the impact that had on asset class performance shortly. However, we think about the longer term, if you will look at the top chart on page 3, there is an interesting sort of dynamic unfolding. And in that top chart, what we're showing is the market's expectation for inflation.
Your page 7.
Oh, I'm sorry, page 7. Thank you. No, my apologies, page 7. So the markets, what this is showing is the market's expectation for inflation over the next 10 years, less the market's expectation over the next 5 years. And you can see that gray line is usually positive. So what that means is the 10-year expectation has been higher than the 5-year. So if you think about it as an accounting identity, that means that years 6 to 10 over the next decade are higher than years 0 to 5 because the whole 10-year is higher than the next 5. But look at the right hand of that chart where it's actually gone negative. So that's flipped on its head. So now the market is expecting higher inflation over the next 5 years than the next 10 as a whole. So this short-term burst in inflation that may come to fruition, at least right now, the market's expecting that to come back in line with historical averages over the next decade. But that's going to be a key item or theme to be cognizant of. Does that flip back in the other direction? In other words, does 10-year inflation, that expectation, become higher? Are we looking at an environment of higher sort of structural inflation than we've seen over the past couple of decades? So if you can skip ahead to page 9, we'll shift gears now and talk about markets and start to weave in some context for the fund itself. So please focus on the chart to the right again on page 9. If you look up and down that graph, on the left side, we're showing major asset classes, whether they be equities, fixed income, or inflation-sensitive assets like TIPS, commodities, and REITs at the bottom. So if we start with equities up at the top there for U.S., international, developed, and emerging market equities, the green bars are showing the Q1 numbers. The darker bars are the 1 year, so we'll focus on Q1. You can see U.S. equities up north of 6% during the quarter, so a very strong quarter. Investors really pricing in that continued economic recovery, and in sympathy with that, a big rebound in corporate earnings, which we did see. Q1 earnings came out in mid-April to mid-May, and they were very strong relative to expectations. You can see international and emerging market equities, they posted gains but underperformed the U.S., and we believe that was largely related to COVID concerns. So outside the U.S. and international developed economies, places like the U.K. just extended their lockdown for a number of weeks. We think about emerging market economies, unfortunately places like Brazil and India certainly experiencing a rise in COVID cases, so that weighing on sentiment for those markets, causing that underperformance. Beneath emerging market equities, you see U.S. bonds, and that was where the real action was during the quarter. So I talked about the inflation concerns before. So as inflation became to the forefront of investor expectations, that caused a rise in interest rates. So when rates go up, bond prices go down, and that negative 3.5% was one of the worst quarterly returns in fixed income in quite some time. Now, when we see the retirement funds returns shortly, it was a little better than the 3.4. For the first reason was the active managers outperformed their respective benchmarks, so that provided a little bit of a tailwind. Now, what was a detractor, if you recall, when we met in February, we looked at the fixed income in aggregate. And the key takeaway was that the fixed income had a longer duration than the benchmark, quite simply meaning that it was more sensitive to interest rate changes. So in the first half of the quarter, or really the first 2 months before we lowered that duration or lowered that interest rate sensitivity, when rates were moving up, that was more harmful for the fixed income in the portfolio relative to that benchmark. But then we brought that duration or that interest rate sensitivity back in line with the benchmark when those changes were approved in February and then again in early May. The last thing I'd like to mention on this page, if you look all the way down to the bottom, you see U.S. REITs there. So that was up 8.3% for the first quarter. And there are no REIT investments in the portfolio right now, but the reason why it's important is from a policy perspective, the policy calls for 8% allocation to REITs. So there's a little bit of a mismatch right now between what the policy is calling for versus what is actually being done. More specifically, the real estate, as you all know, at least through the end of the first quarter, was mainly implemented through those private REIT managers and also those closed-end fund real estate managers. So I just want to point that out when we look at the fund's returns here just shortly. That was a big impact because REITs were up 8%, but those managers were up closer to probably about 4%. So that was a detractor, right? So they underperformed the policy index. So that was a little bit of a detractor for the fund relative to the benchmark.
May I ask two questions?
Yes, sir.
Flipping back to page 7, the bottom chart, if those projections pan out will we be in an inverted yield curve at that point?
The inverted yield curve, yeah. So just a quick backstory. So the bottom chart on page 7 is showing short-term interest rates, essentially what the Fed is planning to do with the overnight interest rate that it controls. So if you look past 2020, what we're showing in the blue line, that's what the Fed said, at least says it's going to do right now. But the market is projecting that the Fed will have to raise rates a little sooner than that. This data is a little bit dated. It was as of the end of March. The Fed recently, I believe last week, updated their projections. And now, interestingly, that divergence has closed a little bit. Now the Fed is saying they may hike interest rates 1 or 2 times before the end of 2023. And given that response, it was a little bit unexpected by the market. So we did see a flattening in the yield curve where short-term interest rates rose and longer-term rates fell. And at least historically, the difference between short-term rates and longer-term rates are called the yield curve. And when it's very positive or upward sloping, when those longer dated maturities are yielding more, that's generally indicative of a positive economic outlook. When that yield curve tends to narrow, or those longer rates come down and short rates move up a little bit, then at least history would suggest that could be somewhat of a red flag. So at least as things stand right now, it's still very, very positive, but it has narrowed since we ran the data here. So that's a key item to keep cognizant of as we move forward, because again, if it inverted, then it would be a yellow flag, because that's exactly what we saw before the pandemic. Nobody predicted the pandemic, but it was in line with what history would suggest. An inverted yield curve tends to be indicative of pending economic weakness and poor market returns.
And my second question, on page 9,
Yes, sir.
the bars pertaining to REITs. So not all REITs own the same things,
Yes.
all right? But given what we see in the decimation of shopping malls, strip malls, housing with evictions and things like that, yes, we don't have anything in that space now. Is that maybe a good thing, unless we're looking for a REIT that is tailored specifically to something else? Cell towers, hospitals, whatever.
So to answer that question, within the REITs, and we'll get into this when we look at the REIT search shortly, we actually show a breakdown of the sector allocations. And a lot of those other sectors like cell towers, billboards, broadband are included in what's called specialty REITs. So there are decent exposures to those areas through the REIT managers under consideration.
But on a broad basis, would this be a good point to have extra exposure, whatever's embedded down in there, to shopping malls?
Well, not necessarily shopping malls per se. And when we look at the data, we'll see the retail allocations. They're minimal relative to the other portfolio. But if you look at the quarterly return, it obviously outperformed. But over the 1 year, it's almost 30 percentage points behind the benchmark. So it's always important to think about the exposures, but also what's in the price, right? In other words, that these things have been hit so hard pre-pandemic and then have underperformed so drastically post-pandemic, then they are still cheaper than, say, the broad U.S. equity market.
So you're seeing it maybe as a value play?
Yeah, that's
Okay.
a good characterization. Absolutely.
Thank you.
You're welcome. So if we skip ahead to page 10, just want to make a couple of quick comments around equities and fixed income before we shift gears. So on the top of page 10, you see the rolling 1-year return for the broad market U.S. equity index, and that last 62.2 at the top right there, that's the 1-year return off the pandemic low, which has been nothing short of historic, to say the least. The best return since the early 80s, but importantly, it's really been a tale of two halves. If you think back to Q2 and Q3 last year, the market leaders were still kind of those growth type stocks. say, things that would do better in a work from home type of environment, like a Zoom or a Peloton, things of that nature, where the economic outlook was still a little bit muddied. But in Q4 and Q1, as we'll see, there was a big shift in market leadership, namely value stocks began to outperform growth stocks quite dramatically. In fact, in Q1, value was ahead of growth by about 10 percentage points, given the economic opening and the rise in rates. So if you recall, when we met in January, we did a big exercise really digging deep into the U.S. and non-U.S. equity exposures, and there were these massive growth tilts. So at our recommendations and the board approval, those tilts or bets towards growth were mitigated and more balance was brought into the equity part of the portfolio. So that was implemented more in February. So prior to implementing that, it was a little bit of a headwind since value led, but once we got more balance, it proved more helpful in the back half of Q1. So with that said, if we just skip ahead to page 12 quickly, and if you look at the top right, just to illustrate some of the comments I made around fixed income, that top right chart is showing the yield curve. So the yield for various treasury maturities that you can see in the horizontal axis, where it shows the zero, the shortest maturities, to the left, and then increasing maturities as you work from left to right. The dotted line is where things stood at the end of the year, and the blue line at the end of March. So again, a big jump in rates and intermediate longer-term maturities, which really drove that negative return from fixed income. But even still, if you look at that blue line, that's still very low relative to historical standards. So like we talked about before, low yields, low returns moving forward. So the outlook's improved slightly still, given what happened in the first quarter, but over the intermediate and longer term, with yields at these levels, fixed income is still going to be, fairly challenged relative to history. So with that said, let me pause for a quick second before we get into the results from the fund itself to see if there are any other questions or comments. Okay. So if you could please hop behind Exhibit 3, we will get into the fund results itself, starting with page 18. So before we get into the data, we also like to hit the high-level observations. What were the key things driving things throughout the quarter? And then looking ahead, what else are we going to talk about? So you see the observations at the top. The market value for the fund was a shade under $123 million, had a portfolio gain, so an investment gain of about $4.2 million. And then the fund returned 3.6% net of fees versus the policy index of 3.4. Now, if you see that sub-bullet point below here, this is incredibly important. So for those private equity, private credit, and private real estate investments, those are reported on a lag. So the data that we have for those investments are through December at this point. So in other words, they're carried at zero in Q1. So what that means is we begin to get those statements, which we've already gotten some and will continue to get them later on, that you can expect, since about 11% of the fund is allocated to those areas, if we just assume maybe a 2 to 3% return, then that 3.6 number should be, closer to 4 when all is said and done. And I'll talk a little bit later on about an exhibit that will show that not just shows what's happening currently, but then we'll show you the revised numbers. Because given it's such a large part of the portfolio, it's important to see not just carrying it at zero every quarter, but what actually happened.
Do you think we'll have all of those reports in by the end of this quarter?
For when we do the next report in August, yes, sir.
Okay, thank you.
Yep. So below that, the two main bullets where you see the attribution numbers, what attribution is essentially explaining the difference between how the fund did and the benchmark. So positive means what helped. So a few things there. Number one, equity overweight. So like we showed previously, the fund has had a decent overweight to equities, largely sourced from an underweight to alternatives. And as I showed, equities, did the best. So having more money in an asset class that does the best is helpful from a relative perspective. The other two items, I've talked about the outperformance by the active managers, and then the hedge fund managers also had a strong quarter as well, so that was helpful. On the negative side, I talked about the fixed income structure, sort of the headwinds from rising rates before we were able to make some changes, and then the real estate structure as well. So the benchmark was up 8%, the manager's kind of around 4%. So if you're 4 percentage points behind with a target of 8, then that, quite simply is a headwind of about, 0.3 percentage points or 30 basis points. And then looking ahead, again, these are the items we'll tackle later on in our discussion. So if you look at 19 again, we show things at a very high level, and then we'll break it down as we work through the rest of this book. So we can start up top here in the summary of cash flows. You can see the fund began the year at $117.6 million. There's $1 million of a cash inflow, and then you see that net investment change of $4.2 million. So the fund grew by about $5.2 million in the first quarter. For the fiscal year, started about $99.1 million, about $175 in cash inflow, and then a $22 million investment gain. So the fund grew by just under $24 million in the current fiscal year. And we'll have an updated number we'll show you shortly. The fund has grown by another $6 million just so far here in Q2. For the returns in the middle of the page, I want to skip that for a second. We have a more detailed page that we're going to spend a couple minutes talking about that in just a minute. But if you look at the bottom asset allocation, really what we're showing here all the way to the left are the respective asset classes included in the policy. The current, those are the allocations at the end of Q1, and then you can see the policy numbers there. So two things. If you look at the policy and you work your way down towards the bottom, third up from the bottom or that blue line, you see 4% to commodities. So that's in the policy right now, but there are no commodity investments. So that's why it looks a little different, whereas, it's a dash for commodities, but there is a target in place right now. And then to the right, you can see the differences. So what that means, if you just look at the top at U.S. equities, where there's about a 6.5% overweight, from a dollar perspective, that would mean the fund is about $8 million overweight equities at the end of the quarter. And as you work your way up and down the page there, obviously that would sum to zero because you have over and underweights. Yes, sir.
I have a question, because maybe I didn't understand something. Back when we were talking on page 9, you had pointed out the U.S. REITs and said that we had none in the portfolio and that the policy called for 8%.
Right.
But what, REITs and real estate, two different things?
So from a policy level, calls for REITs, but what's in the portfolio is what's open-ended real estate and closed-end real estate. So we're just calling it real estate for this because that's what's in the portfolio. But then you can see the 8% target within the policy. The benchmark is defined as REITs.
Okay. And so we have 0 REITs, but we have 7.9 of real estate?
Yes, sir.
Okay.
That's correct.
Okay.
And that was those private investments?
Yes, that's correct. Many of which have been liquidated. They were still here at the end of the quarter. That's why we're seeing them here, because we're as of March, but they've since been liquidated, and I'll speak more to that when we look at the fees shortly.
So are we looking to take the asset allocation that's currently 7.9 and put that all into REITs at some point in time to get away from the closed and open?
Well, that will really be an output of our asset allocation discussion that we'll have later in the meeting.
Okay. I'm just trying to
Yep, understood.
wrap my head around it, so thanks.
And David, just one other point. This is reflected as of March 31, and some of those have been sold. Right.
Oh, right.
So that percentage isn't necessarily accurate today.
Certainly.
Correct.
But at the same time, aren't we on the hook for another, 9 million or more
Calls. Right?
yet to be called?
So that's where
Sorry to jump around.
Yeah, no, you're scooping me. No, so the private REITs have been, to Ms. Pratton's point, have been mostly liquidated to that point. So of the 7.9, they do make up the vast majority of that. So
Gotcha. It's a lot less.
It's a lot less now, but to your point, Mr. Walters, the closed-end ones, which are a much lower allocation, are also included there, and those are ones that we can't do anything about right now.
All right, thank you.
So if we can skip ahead, why don't we skip ahead to page 21 quickly? Again, here we start to break down things on a more detailed level. So I showed the cash flow number on a previous page. It was about $1 million inflow in aggregate, and there is admittedly a lot going on in this page. It will not look as detailed as this going forward, and the reason behind that is because of all the changes that were made in the first quarter. the equity changes, the fixed income changes, and also changing investment vehicles. The board recalls moving away from ETFs more to mutual funds to simplify the trading process from an operational perspective. So there's a lot going on this page. If you look on the next page on 22 to illustrate the comment I made about how the private market investments work, if you look at the third row where you see Morgan Stanley Private Equity Access Fund, and then maybe 12 lines before that, what you'll see is those beginning market values are the 12/31 statements. There are cash flows because they're reflective of the calls and distributions that happened during the quarter, but then a zero net investment change because we don't have the 3/31 numbers. So the ending values are adjusted for the calls and distributions because obviously they came from and went into cash, so we don't want to be double counting things. So those market values are adjusted for cash flows, but not the capital balances as of 3/31. We skip 23 and 24 are just a more granular, detailed breakdown of the asset allocation, not just across asset class, but individual manager. But in the interest of time here, I'd like to focus on page 25 for a second. I mentioned a minute ago taking a deeper dive into the returns. And as a quick background, we use a third-party platform called Investment Metrics to generate these reports. We use it, maybe 50 other consultants. So there's trillions and trillions of dollars of institutional assets on the platform, giving us an opportunity to really slice and dice the data on an anonymized basis. So there's a lot on this page as far as the chart and the table. If I can draw your attention to the bottom three rows here, the first you see the number of portfolios. And just to give you a sense of how robust the sample size is here, as you work your way from left to right, there's between 450 and 600 portfolios in this universe. So it's a very robust universe where you can draw a conclusion. And I didn't mention, but these are just public funds. Okay, so no other institution that wouldn't be relevant for you all to consider these numbers. Now, if you focus on the bottom two rows where you see the circle and the triangle and work your way from left to right, those first set of numbers, those are the Q1 numbers I mentioned. So you see the 3.6 versus the 3.4. The parentheses are the peer rank. So that the median would obviously be 50. Lower numbers are better here, and higher numbers are below the median. So you can see for Q1, the fund ranked in pretty much the top third of all public defined benefit funds in the universe. Again, I would expect that number to be closer to maybe 3.8, 3.9 once we get the private markets investments, so maybe top quartile before all is said and done. But what I would like to draw your attention to is, more of the longer term numbers when you say look at the 7 to 10 year, really for two reasons. Number one, you can see the rankings there, but number two, this speaks to the fact of how important asset allocation is, right? Because the returns themselves are pretty much more or less in line with the asset allocation. So asset allocation is one of the biggest, or if not the biggest, driver of performance over the long term. And that's really the reason we spend a lot of time in March, a lot of time in April, and we'll spend some more time today trying to develop that long-term roadmap or outlook and developing the strategic allocation when we update the investment policy statement. So I think that illustrates that nicely as the returns are more or less in line with that, but the asset allocation itself obviously of utmost importance of determining where the fund will eventually get to, where the fund will eventually be in the intermediate and longer term. Any questions around those numbers before we continue on? Just a few other key pages to hit before shifting gears here.
It's maybe a little too philosophical for this meeting today, but could it be that we have the wrong allocation numbers in our policy statement?
So it would be hard for me to speak to. I'm sorry, let me back up. When you say wrong, Mr. Walters, what do you mean by wrong?
Well, how we're doing compared to the rest of the world.
Right. So I think what would take away in some of the information we showed earlier on was that the policy was quite different relative to a lot of the other peer funds out there. And you can see in the numbers that, it didn't necessarily work as well as some of the other peer funds out there. So when we think about, whether it was right or wrong, I can't necessarily answer that, but what I can say, given what we've done over the past couple of months and given our conversation here in a few minutes, we'll be looking to get this on a better track, if you will.
Thank you.
Okay. So page 26 just shows the same data, but on a fiscal year basis. So in each individual fiscal year, you can look at the ranks. I'm not going to run through that or page 27 in the interest of time. What I'd like to do is move to page 28 and talk a little bit about the individual managers themselves, given all the changes. So at the top there, anytime you see a darker bar, that's going to be a composite. So you can see that's the total fund up top. Those first 5 time periods are ones we already showed. If you look all the way to the right there, that data was provided by the previous advisor, so you can see the long-term returns and the long-term rank there. When we look below under total equity, that's the weighted average of all your equity managers. So all your U.S. managers, your non-U.S. managers, your emerging market managers. You could see the equity composite for the quarter was about 0.5 percentage point above the benchmark. That was largely driven by non-U.S. and emerging markets. Within the U.S., we were slightly behind again because in those first 6 weeks we had that huge growth tilt, so that was a headwind for the composite relative to that policy index, but that was mitigated again in mid-February to try and bring things more in balance and ended up proving helpful in the back half of the quarter. Now, a lot of these managers within U.S. equities, you'll see a lot of dashes because of all the changes that we've made. Okay, so we don't have historical returns because they're new managers within the fund. But if you look all the way to the right there, you'll see the various inception dates, with most being February because those were the changes that were made. And then the one in August, American Century, that was a previous fund that's been around for, call it, 8, 6, 7 months or so. During the quarter, they were a little bit behind their benchmark, mainly due to stock selection. They ended up with a decent overweight to Tesla, which underperformed, and not really any exposure to Microsoft, which was one of the growth stocks that did quite well. So they were a little bit behind for the quarter since inception, which is, again, just 6 or 7 months all the way to the right. You can see much more favorable numbers for them. If you look at the developed non-U.S. equity composite, that was ahead of the benchmark. So that's the darker line towards the bottom of the page. Now, one of the reasons we saw outperformance in non-U.S. relative to the U.S. was because of that growth value difference. It was much bigger in the U.S. than in non-U.S. So in the first part of the quarter where we still had that growth overweight, it wasn't as big of a headwind as we saw in the U.S. And then once the changes were made, we brought things more back into balance. Then we saw the positive addition from that in the back half of the quarter. So skipping ahead a little bit and talking more about the real estate on page 29, you can see under that composite, we've broken things out between open-ended real estate, those private REITs, and then closed-end real estate, the illiquid investments. So for the private REITs during the quarter, we did see some positive returns kind of ranging between 1.5%, 8%. The stronger 8% return is within a fund of Blackstone, the fourth one down there that is being liquidated, not even with the board's approval. That was a decision by Blackstone itself because historically the fund hadn't done particularly well, so they made the decision to wind down the fund. We would expect that money to be fully returned by year end or hopefully quarter one. So when it continues to come back, we'll continue to figure out where to put that money to work. But again, if you take a weighted average of those 4 managers, you're probably looking at around 4%, which again was below that 8.3% that was in the policy. So that was a headwind. When you look at the closed-end real estate, again, we don't have Q1 data, but we do have a page on those returns that we'll look at just shortly. And if you look at hedge funds towards the bottom of the page, some strong numbers. We saw Graham put up almost 8% during the quarter versus 2%. Now that is a manager that's being liquidated because over the long term they haven't delivered. But importantly, just like with any investment, sell high and buy low. So it's great that they're closing out first quarter and hopefully the second quarter with some strong returns. So then that we would expect that money to come back in mid-July, and much like the private REITs, we can figure out where to put that to work when we see it come in at the next meeting in July. If we continue on to the next page here, again, the private equity and credit we'll look at in just a minute. But if you work your way down to the bottom third of the page where you see fixed income. So the composite there, again, the weighted average of the managers down about 3.1% in line with the policy. Again, we had a headwind in the first half of or really January and February when rates were rising. But you can see the two active managers there Delaware slightly ahead of the benchmark, but then Loomis Sales just down a percentage point versus 3.5 for the benchmark. So the outperformance by those managers did offset some of the underperformance that we saw earlier in the quarter. So on page 31, this is a look at all of the private closed-end investments. So we are separating things here. At the top is real estate, private equity, and private credit. So as we work our way from left to right here, we'll just start with real estate. So there are 3 real estate managers there. You see their vintage years, so that essentially means the inception date of the fund when they started calling capital. The respective commitments, what remains unfunded, what's been contributed over the life of the fund, and if they've made any distributions yet. The valuation is their 12/31 balance. And then you see the performance all the way to the right here. And the most important number of the 3 is the IRR. So when we think about performance, the numbers I showed on the previous page, say for the equities and the fixed income managers, those are time-weighted returns. Okay, and what I mean by that, it's just measuring, say, a growth of $1 or $100 over time because it minimizes or really takes out any impact of cash flows, because you as the investor control the cash flows, when to add money, when to take it away. The manager doesn't control them. Now that is completely different for the private markets. They control the cash flows. They ask for the money. They decide when to return it. So this IRR is not time weighted, it's called dollar weighted return, meaning that in the earlier part of a fund's life when it doesn't have a lot of money, that period won't carry nearly as much weight until later in the fund when they are managing a lot of money. So that period will have a bigger impact in the return than when they just have a little bit of money. So you can see in aggregate for the real estate managers there, it's just about 4%. The funds are relatively new. Like we talked about in the past, they generally fundraise over a couple years. They make investments, and they tend not to realize value until, say, 5, 6, 7 years into the life of the fund. So we would hope that over time that 4% comes up maybe to, say, 10, 11, 12% over time once these funds begin to mature. And I think that's nicely illustrated by the private equity composite, where you see in the vintage years there were 3, 4, 5 funds that commitments were made to much earlier. So when you look again at the IRRs all the way to the right and then summed up in that blue for under private equity at almost 13%, that's more what you would want to expect from making those types of investments. If you decide to do that, you want to be compensated in excess of what's available in the public markets, anywhere between 3 to 5 percentage points. So that's a little on the lower end of your expectations of what you would want to be compensated for. We would hope that would be more in sort of the 13 to 15% range. And again, I should mention these IRRs are net of fees. They do take into account the fees being paid by the managers.
Would you unpack, please, the 2 acronyms that are to the left of internal rate of return?
Yes, I'm sorry, I can do that. So the DPI is distributions relative to what's been paid in. So that means if you could see those first 2 rows in the real estate, so they haven't made any distributions. So it's distributions divided by what you've paid in. In other words, the contributions that have been made. It's just sort of a fraction. So that's why it's 0 for them. And then the DPI for the last one in Bridge is a positive number because they've made contributions of about 27% between what's already been contributed.
So what do those letters stand for?
I'm sorry?
TVPI.
Total value divided
Total
by what's
value
been
paid in.
Yes, sir.
Thank you.
You're welcome. So then finally, at the bottom of the page for the private credit composite, the takeaways there are largely in line with what we saw in real estate, given those funds have relatively short horizons to this point. So the IRR in aggregate is around 6. We would expect over time to want to be compensated more in sort of the 9 to 10% range. Again, a premium relative to what we would expect in the public market. So for real estate and private credit, it's still a little early to draw a lot of conclusions to this point. I think, you actually have to wait 2, 3, maybe even 4 years in order to determine, have these investments performed in line with what you would have hoped for, approving them in the first place, namely compensating you more than just moving the money into straight equities and the listed equities.
But even if they do what we hope they do,
Yes, sir.
isn't there a time value of money that we could be doing other things with while they're in the accumulation stage, or we're waiting for them to call those allocated dollars away, et cetera?
Yes. So what exactly happens is, if you make a $2 million commitment, they don't call the $2 million at one time. So the difference is invested in other areas of the portfolio, and then you would generate that cash as they make those calls over time through rebalancing. So you don't just have to hold it in cash, because you do get at least 10, 12 days notice for when they're calling the money, so you can make a decision or keep a requisite amount in cash, assuming calls will come over time in between meetings when we don't have time to make a decision about where to source the money. But all the unfunded commitment isn't sitting in cash. It's invested throughout the rest of the portfolio.
But even taking that into account, didn't you say in a previous meeting they could extend the closeout by another 2 years?
Yes, that's right.
So we could go to 7 years to see how things pan out?
So actually, I mentioned the 5, 6, 7 years. That's when they start to realize value. But to your question, Mr. Walters, a lot of these funds have in their legal documents, the life would be between 10 and 12 years. And then they can, per their discretion, ask for 1-year extensions from that point. So in actuality, it could be anywhere between 12 and 15 years. But at that part of the fund, that part of the life of the fund, they would have already returned most of the money at that point. It would just be maybe 1 or 2 assets that are still looking for strategic buyers, or admittedly might just have to write off at the end of the fund. But the value at that time would be minimal relative to the original commitment.
But either way, it is acknowledged as being a long-term recognition of a hoped-for payout.
Yes, sir.
All right.
Yes, sir.
Thank you.
You're welcome. So if I could just draw your attention as we wrap up here on page 33, I believe I might have mentioned this at a previous meeting, but I don't know it's something that you may have received in the past, but we include a fee summary for every single investment that is in the fund. So you can look to the left of the page there. That is all the equity, fixed income, private, real estate, cash, you name it, everything that was in here as of Q1. You can see the fee schedules in the middle of the page, the percentage of the portfolios, and then the estimated annual fee for each of the investment managers as you work up and down the page here. And again, there's a lot of data on this page. The key takeaway is on the next page, on page 34, all the way at the bottom where you see the aggregate fees. So right now, all the way to the right there, you can see there's 0.59% in fees. So that is on the higher end. Most institutions of this size would think probably more in the low to mid 40s. Now that will come down because we are also including those private REITs. We're at 1.25%, which has been liquidated at about 5 or 6% of the portfolio. So really even doing nothing else through the end of this quarter, that's going to come down to maybe the low or mid 50s. And then once Graham is liquidated at the end of June, then we can expect a further reduction in fees. So over time, that's going to be a big theme or point to continue to review to keep those fees down and bring them down over time as we continue to work with the investments that are in the portfolio and cull the roster.
And after all those adjustments are made over time, what would be a good ballpark figure that we should be kind of looking at?
I think it depends on what the ultimate asset allocation is. Obviously, more straightforward is going to be a cheaper cost. But again, I think the median for an institution of the size of the fund is probably in that low 40s type range, to mid 40s, so a 50% reduction from where we stand today.
Okay, thank you.
You're welcome, sir. So that wraps up my comments as far as the report is concerned. Happy to answer any other questions or comments the board has at this time.
No? Okay.
All right.
Well, if there's no comments, I'd look for a motion.
I'm trying to find a page here.
There is a comment.
I'll make a motion to accept the March
One-
31st. Oh, sorry.
1 second.
Oh, yeah, we'll go with that. I do have a question, but it doesn't
Go ahead.
hold up accepting.
No, go ahead.
Where you had at the beginning all the different sectors, how they were performing. Okay. So this is kind of a naivete question, but do we have too many things in our portfolio?
Too many things, meaning managers, asset classes, both?
Not so much asset classes. We might have the right number of classes, but overloaded the number of managers that we need to get them populated.
Yeah, I would say that there are more managers than we typically see. So, think about it as a process. So we started off with implementation and thinking, how can we kind of improve this structure? And now we'll do asset allocation, but it's a continuous process or sort of feedback loop. And once we get that latter piece, then we're going to circle right back to implementation to make sure, to your point, do we still need all these managers? Do we need to tweak any of the strategies and things like that to get it more in line where we ultimately settle on asset allocation? But to your question, I would fully expect to be a reduction in the number of investment managers as we head forward based on that outcome.
Okay, thank you.
You're welcome, sir.
Thanks. Do you have a motion?
I move to approve the first quarter 2021 SORP performance report.
I will second.
We have a first and a second. All in favor?
Aye.
Aye. Motion carries. Ayes have it. Next, we have discussion materials, which would be the REIT manager search, I think is
Yes,
next.
sir. So this is in the other book. All of those items are in the other book that we will tackle in order per the agenda. So again, if you could bear with me and hop behind that hardcover page and then where you see the cover page as far as St. Mary's County SORP discussion materials, and look at the table of contents quickly. So as a broad overview of what we'll discuss today based on our conversations at the April meeting, bringing back more options for the board to consider for a REIT allocation. So we'll walk through those options, talk about characteristics, exposures, returns, pros and cons to make that decision. That will flow right into the recommendations if the board decides to move forward with a new REIT manager, where to source the money for that investment. And then we'll round out our discussion with asset allocation and then a custody overview, which is something that we've talked about for quite some time, meaning that now, we tackled a lot from implementation. We're kind of towards the tail end of asset allocation. So let's continue on those next steps, those priorities, those custody evaluations. We have some key data really around pricing to show the board about, what could possibly be expected in an RFP process. So we'll round out the discussions there. But with all that said, please hop behind Exhibit 1 and we'll look at the REIT manager search here. So this is on page 4 where it says manager overview. So in the top gray bar, there are 3 managers that we're putting forth for the board's consideration. The first is DFA, Real Estate Security Strategy. The second there you see DWS, U.S. Real Estate Security. So those are both active managers. And then again, the Fidelity Real Estate Index Fund for your consideration for a passive approach. Now, when you think about the spectrum of, say, passive investments to active investments, it's not one or the other, right? There's certainly a spectrum because there are differentiations in the active manager universe. So all the way to the left would be the Fidelity Index Fund, a purely passive fund trying to track that benchmark. DFA would be somewhere in the middle. They're more of what's called, say, an enhanced index manager, where they're making slight tweaks to their holdings relative to the benchmark based on their strategic belief. But they're a fairly diversified portfolio, and because they're only looking at things from a quantitative perspective, say valuations, income statements, things of that nature, they're not necessarily meeting with management, talking to suppliers and competitors. They keep the costs of the portfolio down fairly low. And then all the way to the right is DWS. They're your traditional bottom-up stock picker, trying to look at the cash flows for the companies, the supply and demand dynamics for their underlying real estate holdings, again, to try to pick the winners and the losers within that marketplace. So there's a lot of information on this page here. I'll talk about some of it at a high level, but focus on the more important characteristics. So you can see all three strategies have more than a decade of being in existence there. All three strategies are fully at scale, meaning that they have billions of dollars in assets in the fund. And then the number of holdings, just echoing my comments there, you can see DFA about 150 holdings. So a very diversified portfolio, not terribly different from the index, just making tweaks here and there. But if you contrast that with DWS, only about 40 holdings. Again, so they're a pure active manager trying to identify those winners and losers, typical of what you would see from an equity manager, just holding maybe 40, 50 securities relative to the benchmark. And then again, Fidelity at 175 securities, the most diversified because they are holding everything in the benchmark. Now, in the top 10 holdings, again, should be somewhat intuitive, given the fact that if you are a more concentrated portfolio, again, you see DWS in the middle, then you would expect more of that to be in your top holdings. So almost half of the portfolio, their top 10 holdings account for. DFA to the left of that, a little bit more diversified, and then to the right, Fidelity, even more diversified, again, because they're holding every single security in the index itself. As far as cash below that, that's really relevant for the active managers. Again, we don't really want to pay anybody active fees to hold cash, right? So we want them to be fully invested most of the time. So the fact that those numbers are low is a good sign that they're doing what we would want them to do. And then if you look at the dividend yield below that, I included that specifically because DFA is a little higher. So one of their strategic beliefs is to invest in more undervalued type securities, cheaper securities across their platform. So if you have lower valuations, lower prices, then you would expect a higher dividend yield for their stocks relative to the other two options for the board's consideration. You can see the weighted average market cap below that, so that's just company size. So not terribly different between DFA and Fidelity. However, DWS, they tend to have more of a lower a higher exposure to smaller cap companies or smaller companies. And then most importantly, there at the bottom, you see the fees. So DFA, very reasonably from a cost perspective, given it's an active manager. DWS, a little higher. And then Fidelity will obviously be the cheapest option because it's just a passive fund tracking that passive index. But all three of those well below the average sort of active U.S. REIT fund, which is sort of more in that 80 to 1 percentage point range. So with that said, if you look at the next section to circle back to some of your comments, Mr. Walters, I think a key takeaway here, and we box this up, is that office and retail exposure. And the big takeaway there you can see in those boxes is that DWS certainly has much lower exposure to the office sector and a slightly lower exposure to retail. So them being more of an active manager, think of them as more fluid as opposed, in sense of making changes to the portfolio over time, where the latter two options are going to be much closer to the benchmark themselves. And then all the way to the right there, you can see the specialty. That's pretty much a catch-all for anything that's not in those other buckets. So again, REITs that operate cell phone towers, data centers, billboards, farmland, timberland, but those non-traditional sectors have become a much, much bigger part of the REIT universe because in order to be a REIT, you actually don't have to own and operate commercial real estate. It's actually a tax status. Whereas you as a company have to distribute 90% of your earnings to maintain that tax-favored status. So over time, many companies have sort of shifted or claimed this REIT status to gain that favorable perspective from an income tax perspective, and then just pass along pretty much the predominance of their earnings back to their investors. So with that said, before we hop into the returns, one of the conversations, if we look at page 6, was, Fidelity changing their benchmark more recently. So what I wanted to do, I thought would be helpful, was show the performance of the benchmark that Fidelity's tracking now, which is the orange line, versus the blue line, which is this FTSE Nareit All Equity REIT, which is more the most sort of industry standard REIT index that's been around since the late 70s. And importantly, you can see they're pretty much right on top of each other. So the reason, again, for showing this, when we look at the returns, the Fidelity returns aren't necessarily relevant because they've been tracking a different index since prior to December of last year. So when we look at this data, this FTSE index is included in the data. So when we think Fidelity, that's really a better proxy for the historical returns for the Fidelity index because they were tracking a different index prior to December 1st of last year. So again, when we look at the rest of the data starting on page 7, and there's a lot of data on this page, please ignore the top chart there. It's a little difficult to kind of decipher what's going on. I think the table is much more helpful, where you can see the returns of the 2 active managers on top across their respective periods, and then the relative rankings compared to the universe. So as you work your way from left to right from those 2 actives, there are times where they're below the median, but it's been fairly consistent over time, sort of in that top quartile or second quartile relative to the index, a lot owed to their investment process, but also a lot owed to their lower fees over time. If you look below Fidelity to that benchmark I spoke to, it's a similar story, right? 1 year a little bit below the median, but then 3, 5, so on and so forth, more in that top quartile, second quartile. And the reason behind that, again, like we talked about, the universe of REITs is minimal, right? Fidelity's an index fund, and there's only 175 securities. So if you're investing in an area where there's so few securities and then the differentiation of returns isn't all that much, it's hard for managers to outperform net of their costs and net of their fees. And that's why you see the U.S. real estate at the bottom of that page. That's the average fund over the longer, intermediate, but particularly the longer 10 and 15-year returns, sort of comfortably below that median, where we have multiple market cycles to incorporate and to take into account. So anything can happen in a given quarter or a given year and things of that nature, but over the longer term, again, fairly difficult for most active managers to outperform the benchmark. So skipping ahead to the next page, on page 8 here, it's a similar story, similar analysis, but instead of looking at the cumulative periods, it's looking at individual years. The year-to-date number is through April. But again, please just focus on those bottom table there where you see the returns and the ranks again. So again, those first 2 managers sort of oscillating sort of above and below the median for the first couple years, but pretty consistent over the long term. Even if slightly below the median when things are going well, they generally rank pretty favorably. A similar story with the FTSE Nareit All Equity REITs index below that gray line, sort of oscillating above and below the median, but again, longer term in those earlier years, generally in that top quartile again, because it's difficult for active managers. And you can see the active manager returns, they're really oscillating above or below the median, not necessarily too different since it's an aggregate of everything in the universe. So on page 9, we talked a lot about returns, but risk is obviously very important as well. So on page 9, you look at that top chart here, it's just a simple risk and return graph where the horizontal axis is the returns over the past 5 years, the vertical axis, and then the horizontal axis is the standard deviation or risk. And if you look at those lighter gray circles in there, that's all of the managers in the universe there. And you can see, a lot more than half of them, as we would expect, again, below the return of where you see in the circle, which is DFA, DWS, and that FTSE index essentially right on top of each other. So the risk and return characteristics of those three funds have been very favorable relative to peers and also in line with each other over the past 5 years. And similar to that, if you look on page 24, another measure of risk here, drawdowns. So essentially peak to trough returns over the past 5 years. And notably, you can see the biggest drawdown, again, not surprisingly, in that top chart in early 2020 amid the pandemic. The numbers themselves are in that bottom left table, where you can see the max drawdown for DFA and DWS, around 24-25%. And then that FTSE benchmark, 24% as well. So consistently, sort of returns in line with each other that are favorable relative to the universe, but not just from a return perspective, from a risk perspective, in line with each other, sort of all good candidates for the board to consider for the mandate. So to sum up on page 11, we walked through a lot of things here. So what's the takeaway, as far as pros and cons are considered? As far as DFA, strong long-term track record, low fees. Cons, they do have the highest office and real estate exposure. DWS, again, a strong long-term track record, lowest office and retail exposure, but the highest fees. And then finally, Fidelity, lowest fees, moderate exposure to those areas, but they have changed their benchmark over time. So just quickly, why would somebody change their benchmark? Probably a couple reasons. Number one, and I would say that this is different than an active manager changing their benchmark, but important nevertheless. So number one, that MSCI index that they're tracking now is only about 5 years old. So they might have come to a conclusion that this is a better representation of what they should be tracking in the market moving forward. But more importantly for investors, when you have an index fund, those managers have to pay licensing fees to the index providers. So MSCI constructs this index, and Fidelity, in order to track it, needs to know what the holdings are. So they have to pay a licensing fee to MSCI, which may only be a basis point or two, but that's built into the cost. So if this fund had a cheaper licensing fee than the previous fund, then they'll change the benchmark and pass along those cost savings to shareholders. However, as we look forward here, I would expect that they wouldn't change the benchmark again, but I can't say that with any certainty. And if they do, then we could find ourselves in a position where we have to revisit and have another conversation about it if that happens. Again, I wouldn't expect it to happen, but it's not out of the realm of possibility.
So
Yes, sir.
my question is, I understand active management versus passive management, an index fund versus not. So Fidelity's passive index fund is for this MSCI, but it seems like FTSE, the FTSE or whatever it's called, seems to be much better. Is there a passive one for FTSE? Is there an index fund for FTSE?
So the biggest index fund managers in the space, both Vanguard and Fidelity, track the MSCI index. So the reason that it doesn't have a long track record is because it was only incepted, or MSCI only created it
Right, I understand
about
that.
5 years ago. And that's why I wanted to show earlier on the performance of MSCI versus FTSE, which has essentially been the same. So historically, Fidelity was tracking something else.
So let's go back to the numbers then that show like a 9% versus 5% for the FTSE. Where would that have been in your, let's see. Is it page 7? Right, page 7, which shows the 5 years then, has the DFA and DWS at roughly 9, and then the FTSE is roughly 9 at 5 years, but then Fidelity tanks all the way to 5.9. Is that because of the difference?
That's because it was a different benchmark prior to December 1st, 2020.
The different benchmark would have been the FTSE benchmark.
No, it's a benchmark that's not on this page. It was actually called the Dow Jones.
Oh, they did something, okay.
Yes, I apologize. Yeah, they were tracking a different benchmark called the Dow Jones Select real
So
estate.
now they're on board basically with a generic version of FTSE then, or,
With a different version of FTSE, and that's common among those index providers.
sure, you steal something that works. I get that. So if we were to go with, and that's why, because I was not as impressed with them, but what you're telling me is if we were to go with Fidelity, we would more likely see FTSE.
Those types of returns moving
Right,
forward.
which, and if you look at the FTSE returns on that same page as 7, it tracks your, like, your 5 and 10 years track your 9, your roughly your 9%, which is what the DFA and DWS that you're paying more for, active ones that
That's
you would pay
correct.
for.
That's correct. I should mention these returns are net of fees as well. too.
Okay, so
just that point, that important.
Not to push anybody in any direction, but that was the hangup I had about Fidelity, but thank you for
Right.
untangling that and the mess I call a mind, and I'm happy with Fidelity then. I don't mean to jump ship on anybody or,
It's called front-running.
okay. I don't know if there's,
Because if they're all tracking, if they're all returns that are going to track the index, why would you pay more?
right. Look, I
So
love my index funds anyway, so.
you had slipped a word into your presentation way back at the beginning, and the word was enhanced.
Yes.
I get real nervous when I hear the word enhanced associated with an index fund. Can we unpack that a little bit?
Yes. So when you think about an enhanced index, it's active in the sense that it's not tracking the index to a T, but it's just making slight tweaks, trying to add a little bit of value. So what DFA does specifically is they'll look at the universe of investments, but then they will weight the securities a little bit differently based on 3 measures. Number 1, cheaper securities will get a little bit of bigger weighting. Number 2, higher profitable or more profitable securities. And number 3, they tend to, not so much in this product, overweight smaller companies, because this gets back to the Fama French analysis way back in the day, who worked at DFA a long time ago, their value premium proposal and their small cap premium proposal that would outperform over the long term. So they're not doing any fundamental analysis, like meeting with companies, suppliers, competitors, and things like that. They just look at the balance sheets and the income statements to make those slight tweaks. So over time, when you think about relative to the index, DWS, since they are an active manager, you could expect more deviation relative to the index since they're more concentrated. Whereas DFA, you're probably getting more index-like returns with the hope that maybe over 5, 7, 8 years, maybe you're 10, 15 basis points ahead. And that's why they offer it at such a cheap cost.
Would they also, under the term enhanced, be doing things like puts and calls and other strategies?
No, it is 100% long-only equity.
Okay.
And so then to make me still feel comfortable about Fidelity, on page 9, then the whole reason that the Fidelity orange triangle looks so much sadder than the FTSE one, again, over time, that triangle is going to basically go up to where FTSE is what you're telling me.
Right, so this data is through April. They changed that benchmark at the beginning of December, so 5 out of the 60 months are at the other benchmark, and 5 out of the 60 are at the new benchmark, and 55 out of 60 are at the old one, which was admittedly, and you could see through the
Right.
numbers, more aggressive type of real estate index.
But what you're basically saying is the Fidelity one's going to, when it's all said and done, is going to match the FTSE.
Unless they change the benchmark, which again, I would not expect.
Well, that's why we have you, right? Because you would
Again,
let
I
us
would
know
not
that.
expect, but obviously if that would happen, I would bring
Right.
that to the board's
Right.
attention.
Right.
I don't think they'd tell him anyway.
Fidelity's a big firm. They are under a lot of compliance and regulatory pressure, so that would come out, I assume, in
Being a big firm does not ensure that. We've already been there.
That's true.
Wells- yeah, well, okay.
That's a good point. Well,
Okay.
some of them hopefully have learned their lessons. Some.
Not anybody we know.
Okay. So are you now asking us our choice, our recommendation?
So I think we can probably shift to the next section unless there are any comments around that. But in the next section, asking for the board for a decision. Okay. So under Exhibit 2, and again, don't want to jump the gun on the agenda, good to move on?
Sure.
Okay,
that's fine.
thank you. So under the recommendations, before we get into that quickly, just you see the fund allocations on page 13. A couple of quick points there. You can see the total assets up at the top there, the third column over from the right. The fund through the end or through the middle of June is at $129 million. So again, up about $6.2 million so far during the current quarter. Again, equities have done well, so that's proven very helpful. The key consideration down below, if you look at the bottom left chart, is the asset allocation in black, the targets in blue, and then the differences to the right there in green. So again, we're overweight equities. We're within the bands of the policy statement because we got plus or minus 9%. And nearly all of that is being sourced from fixed income. But the last point there, we have a pretty decent overweight to cash right now as we sort of, continue the process of making this decision. So the recommendation here, if you look at the middle column and the rebalancing in the middle of the page, would be sourcing the money from cash, mostly out of Wells Fargo, some from Morgan Stanley as well, keeping some money there for upcoming capital calls. But then moving $4 million is what I've called here the new REIT manager. And then to the right on the bottom of the table, obviously the equities, the fixed income doesn't change, but the underweight to alternatives, where we're bucketing this investment for policy purposes, comes down slightly, and then the cash comes down. So on page 14, as far as proposed board action, we recommend the board approve the proposed rebalancing, outlined on the previous page and some below here. So $4 million to the REIT manager, $4 million from cash. And before we get into that discussion, just to reiterate, that Graham redemption's coming in mid-July. So we're going to circle back up on that in later July.
You know what that amount is?
It would be, if we look on this page, Mr. Walters, where am I? It says new hedge funds. I think it was about 2.8% of the portfolio, so that would be $4 million about.
So we're replenishing the kitty very soon.
Yes, and then the kitty will be high again, and we'll look to make those adjustments as appropriate. So with all that said, again, let me pause for a second for any additional comments around the proposed managers or questions as the board considers that proposal.
What's everybody's thought on the three?
So in the past, we've only, with the previous advisor, they would just generally give us one idea of where to go. We've asked Pat to give us a couple of options and walk us through that. Thank you for that. As we all come to our own conclusions, I'm just interested in what would be your overall recommendation to the board for which one to pick, and then we can discuss if there's any variance between individual board members, perhaps.
So perhaps unsurprisingly, my recommendation hasn't changed from March and April. I think from two main reasons. As we think about REITs, again, it's difficult for active managers to outperform. Obviously, the two we've shown you here, we think highly of. Mm-hmm. But when we're looking for exposure to an asset class and we can do it in a cheap way, I think that's certainly an advantage. And related to that, Sergeant, we're still working through the asset allocation. So if REITs ultimately aren't a part of that portfolio, it's much easier to move out of an index fund than an active manager per se. And then ultimately, if we sit here in 2 years and REITs are a part of the portfolio, then we're going to continue to do diligence across the board, across all the investments, and then make recommendations and changes as appropriate. But as it stands right here, my recommendation would be Fidelity.
Thank you.
You're welcome.
Everybody comfortable with that, or?
And it is, again,
I'm sorry?
yours was,
Fidelity, Mr. Walters.
I'm comfy with that.
Yeah, me too.
Okay, I'd look for a motion then.
Well, I'll move that we put $4 million into the Fidelity REIT as recommended and as discussed, with the dollars coming from essentially cash.
Okay, I have a motion.
I'll second.
A motion and a second. Any discussion? If not, I'll,
Who seconded it?
I did.
Okay. Can I ask you something, Pat,
Yes.
real quick? On page 14,
Please use the microphone.
on page 14, where
Yes.
it says, recommend the board approve the proposed rebalancing as outlined on page 4.
No, I'm sorry, that's my mistake. That is a typo. That should say page 13. I apologize.
Okay.
okay. So I have a first and second. All in favor, say aye.
Aye.
Aye. Ayes have it. Motion carries. Thank you, sir. And we are now on to
Asset allocation.
asset allocation study,
Asset
also by Mr. Wing.
Asset allocation. All right, so you'll find this in the next exhibit, and as I mentioned earlier, this is really the culmination of our discussions over the past couple of months, and I think hopefully I illustrated the importance of the decision based on the performance report. But as we work through these numbers and analysis, it's important to think about this as not in isolation of, X and Y, but trade-offs and sort of the range of outcomes and directionally between all of the options here. So let's skip ahead to page 17 in the interest of time here. So on page 17, what we're showing here is 4 options. And again, I should preface this, we'll walk through this today. If the board wants to, think more about it or request other analysis, then we're happy to do that. So by no means do we need an answer today. If we get it, that's terrific. But if not, happy to provide additional analysis to get us where we need to be. So you can see the first, you see the asset classes listed up and bottom there on the left. You can see the first option is a 65-35 portfolio, so just traditional equities and fixed income per the board's request at the April meeting. Now, importantly, when you work your way from left to right, you see with illiquid. So again, we are sort of locked in to the private equity, the private credit, the private real estate. So what I've done here is adjusted the 35 portfolio based on those exposures that aren't going away anytime soon. The third one is with the liquids and the hedge fund. Again, Graham is going away. However, Millennium, I've talked to you about that a couple of times. They're a very good manager, a track record second to none. So we wanted to include that in case the board wanted to consider maintaining that exposure. And then finally, you see MAI, that's Marquette Associates Incorporated recommendation. So based on the discussions, the education around the asset classes, we wanted to put this in here for the board's consideration. And the key differences around that, you'll see in the boxed up, or excuse me, the darker rows would be a lower allocation to fixed income given the challenges there. Lower allocation to equities, although higher than what you have now. And then in the real estate and other assets bucket, maintaining some exposure to real estate. We can do this through an open-ended or more liquid format that would be more consistent with institutional investors. And then below, global infrastructure. Again, we did an overview of that, the importance of having assets that do well in inflationary environments. And then maintaining the private debt and the private equity target. So when we think about the middle two, those alternative allocations would in theory be coming down over time, right? Like we need it here today because it is what it is. But if we don't make new commitments, the money is returned and it'll be coming down over time. And we can revisit it year in and year out and make tweaks as appropriate. But if you look on page 18, we'll get into some of the data, and I think we can walk through these pages in short order because the takeaways are generally consistent. So this is our base case for the next 10 years. Low rates, like I talked about, some overvaluation within equities suggest a subdued outlook. So you see the 65-35 there, our base case 10-year returns about 6.25%. The middle two with illiquids and illiquids, the hedge ones, a little higher than that. We expect private market investors to be compensated like they have historically, and it is a little bit of additional diversification, right? You're having more tools in your toolkit. And then finally, you see our recommendation there. The middle row there is the volatility or risks for each of those portfolios, but the key dynamic is in that third row, the average return divided by the average volatility. So think about that as your risk-adjusted return. How much are we getting paid for the risk that we're taking? So you want that number to be as high as it possibly can. So that's the summation of sort of a base case outlook, but importantly, I can sit here and promise you that the base case will not unfold to a T. Okay, so that's the base case, but we're highly cognizant of the range of outcomes, right? The trade-offs of these various portfolios. And if you look to page 19, this is more of a range of outcomes on the, say, a worst case scenario and then a best case. So where you see the 50th percentile, those base case numbers match the previous page. Above that, the 5th and 25th percentiles, that's more of a worst case type outcome. That's why those numbers are lower than the base case. Now, admittedly, based on our software and our beliefs, we do feel that more diversification would provide more downside protection, as you can see in the numbers. And then on the upside as well, just having a little bit less money in fixed income could also prove helpful over time. But again, as we continue through this discussion, look at this as directional and then the range of outcomes as well. So on page 20, it's a similar exercise, but as a part of the analysis, we work with the actuary, right? We get the cash flows and we build them in to give you an accurate representation of how things could unfold. And then on the next page, we also collect the liabilities so we can think about the funded ratios. But here again, there's a distribution, right? So if you have a more favorable return range, then obviously that will work to more favorable market value ranges. So you can see the diamonds there in the middle of those columns, that's the base case. And then everything above that would be the upside and below that the downside. So obviously if they have a lower floor from a return perspective, then in theory you would have a lower floor from a market value perspective as well. And it's the same takeaway on page 21. You know, when you have more favorable market value ranges, then that would lead to more favorable funding ratios. So we collected the liabilities from Bolton. That 50th percentile, so that's the base case in any scenario, things are looking good, right? You know, that's the name of the game to improve the health of the fund. In the best case scenarios, you know, be happy with any one of those numbers in any iteration, that's for sure. But then in the worst case scenario, again, the relatives or the trade-offs are exactly what you would expect based on the returns and the market values, meaning sort of, you know, a difference between a straight to traditional portfolio and the ones including a little bit more diversification could provide some downside protection over the long term. So importantly, to wrap up this discussion here, if you look at page 22, you know, really poor outcomes don't tend to happen over 10 years. They tend to happen in bursts, right, in short-term periods. So one of the helpful things we can do with our analysis is to say, what would these four portfolios have done in the financial crisis? In Black Monday, right, in Q4 of 1987 in October, where the market was down 25 some odd percent, and it was a very poor quarterly return. And what the analysis is showing, you can see each of the dots in those graphs are on top of each other in 2021 because that's basically the very start of a crisis. And then the years subsequent to that were how asset classes did subsequent to that. So on the right on those tables, you can see we have a beginning market value of about 125 million in this analysis, what the market values would have been if the portfolios were positioned based on those options 3 years subsequent to the financial crisis. Similar story for Black Monday. What would the portfolios have looked like 3 years subsequent for that crisis? And then obviously, if a 65-35 portfolio has a lot in equities, the portfolios that don't have as much in equities intuitively when equities are doing poorly would lead to slightly better results. On the next page, on page 23, you know, we've lived through a lot of poor equity environments. We haven't had a poor interest rate environment for quite some time, but it's certainly within the realm of possibility given the low rates, where rates stand right now. So it's a similar story or similar exercise. There's a interest rate spike in 94 and in 81. So we look at the portfolios at $125 million and how would they have changed over the subsequent 3 years? So with fixed income, you know, being a lower portion of the portfolio in some of these other iterations, fixed income would be the worst performing asset class if interest rates spiked. So more diversification would be helpful, sort of all else equal there. The last analysis I'll show here on page 24, I think is very helpful. You know, I talked about poor markets tending to happen not necessarily over 10 years, but in short bursts. So we actually do a simulation. So that first one, perfect storm for 1 year. That means equities are down by 20%, rates are up by 1%. So an environment where equities and bonds are doing poorly, and admittedly that's rare, but it's not out of the realm of possibilities. So you could see again, same market value as of 2021 and how they would change over the subsequent 3 years. And again, having less in equities and less in fixed, all else equal with more diversification, the market values at the end of 2024 in the range of say $5 to $7.5 million higher. And then the perfect storm for 3 years, this would be a really poor environment. Equities decline 15% a year, rates move up 1% a year. But a similar takeaway, again, if you look at the trade-offs between a traditional portfolio and one incorporating some other asset classes. So with all that said, I know there was a lot of information. I walked through it fairly quickly because the takeaways were largely similar. But again, let me pause for a quick second here for any comments or questions from the board.
Are we looking to make a decision on this today? Is this just informational?
This is informational. There would be no formal approval. Anything formal would be done when we circle back with the investment policy statement, an update to that. But the strategic asset allocation is a part of that statement.
Certainly.
So we can't do that without coming to a decision here. That's why I mentioned earlier on that if the board, again, it's a lot of information, wanted to digest and sort of circle back in the next meeting or say, hey, you know, Pat, can you look at XYZ? We'd be happy to do that as well. So nothing that has to be decided today, probably just more direction about how to proceed.
I got you. And I guess my first takeaway is it doesn't seem like that big a difference between the 65-35 to your recommendation in terms of, you know, the number between, but I think that's because I'm thinking when I'm used to seeing these charts, I'm doing it for my retirement, right, which is, you know, a gazillion years away, right? So these charts show a huge number disparity, you know, that if I invest, you know, if I take risks, I'm making, you know, X, whereas if I don't take the risks, I'm making Y, and there's a huge difference in number. Your difference, roughly, you know, on some of these is like 10 million, so that doesn't seem a lot to me, you know, in terms overall, but I think it's because we're looking at it in like the next 3 years, right? So if you were to carry this out the way my you know, retirement calculator does, we're really talking huge differences,
And
right?
important, I think it's important to be cognizant of a couple things too. So this is an incredibly important exercise. So once we get to a place that the board's comfortable with, we'll update the policy statement, but we will review this maybe once a year, 2 years at most, as capital markets change, characteristics of the funds change, things of that nature. But unlike your retirement, unfortunately, this fund operates in perpetuity. Right. So
Well,
that's
also, people are withdrawing from it as we speak. Right.
True.
The other characteristic is it's actively paying benefits.
that's true.
Well, that's not calculated in these numbers, is it?
It is.
Oh, wow.
Work with
Okay,
Bolton to
okay.
do the
So I'm,
close, but that's a really
Okay.
good point.
Thank
Mr.
you for that,
Frassen.
yeah.
But even though people are withdrawing funds, according to the Bolton projections, which we have to rely on them for the actuary,
Right.
the cash flows are not expected to turn negative for at least the next decade.
Right, good.
As the county contributions, the employee contributions sort of outweigh the benefit payments and expenses. And if we have that in the back of your mind, the worst thing that any investor can do, thinking about retirement,
Right.
say your retirement with $1 million and the market tanks in your first year and you have to pull money, then that's a big problem because then you have a lower base moving forward, right? It's called sequencing risk. It's much better to have a huge gain in that first year as you begin to draw it down. But if you don't have the negative cash flows, then that becomes less of a risk because you generally don't have to sell something to meet a benefit payment or liquidity need. You really only do it for rebalancing purposes. So the cash flow profile is of utmost importance to keep in mind as well.
okay.
Just an opinion. I tend to be kind of a plain vanilla investor. I like managed funds. I like them from well-established funds with long track records from the managers. I could go with something a little more exotic, such as you've outlined here, than just plain vanilla. But I think the lesson that we hopefully have learned is if we don't dig down and find out exactly what we don't see, we're headed for trouble. We have found some things in retrospect that we probably wish we had known before we went in. And I think that's the only pitfall. I think you have been very good about being transparent, but the devil's going to be in the details if we go with something other than plain vanilla, which I'm going to describe as the 65-35 mix.
Sure.
Preferably plain index or even managed funds.
Agreed, and I think, the biggest takeaway is, sort of the trade-offs between the two approaches. If you think about the earlier section, what we're trying to hit, unless it's lowered in the future, is that 7.25% return. So we have to keep that in the back of our minds. To your point, Mr. Walters, it would be, I don't want to use the words my recommendation, but to the extent that you continue to allocate into some of those areas, I would bring options like we did with the REIT funds. Most of those funds would have many historical vintages that you could look at, and you could see the returns, things of that nature, the holdings. And then for the investment management agreements that, we have a lawyer on staff looking through those. Obviously, we're not party to those agreements. We are a third party. We're a facilitator and an aider, if you will. But to the extent that you wanted to be more comfortable, we have many clients that run it through their, solicitors up in PA or county attorneys to really dig through the black and white of those things as well. And then some of those managers will, if you have any issues with any of the language, they will approve what's called a side letter between themselves and you saying, we don't like XYZ, can you do that? And sometimes they say yes and sometimes they say no, but it's very important to be cognizant not just of the risks of doing something like this, but all the fine print in the contracts themselves. But as I did show earlier on, I think maybe in January and February, the allocation is, say, outside of traditional investments amongst your peers, and everybody's unique and different, is kind of in that 18 to 20% range. And I don't want to speak out of turn, but those of you on the OPEB fund have certainly seen the, somewhat of, well, not somewhat, but a benefit from having allocations to these areas where you're using more institutional quality managers. So if we look at the lineup of private credit, private equity, and private real estate here, there's probably only maybe one or two where we really like. So we would come back with, admittedly, other names for you all to consider. So that was, a lot to digest, but thought important to, put forth in front of the board.
Thank you for that. What is your all roles? I mean, do you have an obligation to go back to the FOP, to your people to say, hey, we're thinking about, doing something like this, or they just completely trust you guys to make?
Yeah, not for decisions like this.
Okay, I'm just.
For other, like the implementation of the drop program.
If you make an amendment, right, I got you. But stuff like this, that's what they voted you on for.
Generally, if it's a benefit enhancement or reduction, if we ever got to that point, we would go and then get feedback like we did for the drop. But
making decisions like this, okay.
For
I
the
got you.
policy statement, for the rebalancing and allocations.
Okay.
We
You keep them informed, but you don't, right.
Generally, yeah.
Right,
yeah.
right. I was just curious. Okay, I got you.
And all this is posted.
Certainly. Okay. Well, thank you.
I do know that we need to make or be close to what our discount rate is based on the actuarial, like you said, so that we're at least making it so that we can, for the long term of the plan, and actually.
Sure, for the
sustainable.
long-term health of the plan, because at the end of the day, say you're making 6% and the actuaries assuming you're making 7.25, then that's an actuarial loss,
Right.
right? And then you're talking about more contributions, lower funded ratios, and the implications that has. So in a perfect world, again, all else equal, your asset allocation would be more or less in line with that assumed rate of return.
Right.
Okay, well, thank you. If that's all there is with that, then the next would be the custody overview.
Yes, if I just ask quickly before we move on,
did you want-
yeah, I need marching orders.
That-
I wanna think on-
Or just to digest, and we can talk more about it the next meeting.
I thought we were at the digesting stage. Is that-
Okay.
That's where I am.
Oh, apologies. Okay, I didn't realize that.
Right.
So we'll come back at the next meeting and,
Is that okay? That was-
Oh, absolutely. Happy to do
Yeah.
whatever the
Yeah.
board sees
So
fit.
that does not imply a huge shift. We're just going
Right.
to bend the curve a little bit.
Right, right.
All right.
And then the investment policy statement would follow based on the board's,
Right.
decision, direction, I guess.
Correct.
Cabela or Rocky Road, right? That's what we're trying to figure out.
All right. So,
both.
for the custody overview, why don't we skip ahead and we'll just get to the main takeaways here. I know that it's my understanding that some of you are pressed for time. If you can look at page 29 behind the previous exhibit. So, when we spoke about earlier on, we're talking about, could there be possible fee savings for all three of the funds, so the SORP, the OPEB, and the LOSAP, to be custodied under one umbrella? So right now, as you all know, the SORP is at Wells Fargo. We also asked informally for pricing proposals from other banks, the first being U.S. Bank. They don't have a big presence in Maryland, but we work with them on a number of other relationships, and we and our clients are very happy with them. The big player in Maryland, all the way to the right, is Wilmington Trust. If you look across the county marketplace, they probably own about 75 or maybe even more % of that market. But with these informal proposals, there's really two key takeaways. If you look at the first, the market value fees, in the middle, Wells Fargo right now is 3 basis points. So we said, well, what if all of the funds are under your purview? They would drop it to 2.5. You could see that's probably, if I'd done the math, maybe 30 to 40% higher than what U.S. Bank and Wilmington Trust is proposing from a market value fee. The other key difference on the second row here would be the annual account fee. So what that means is, if you have a SORP, you have a LOSAP, and an OPEB, they would charge $2,000 for each of those 3 accounts, whereas U.S. Bank wouldn't charge anything, and the Wilmington Trust fee is nominal. But where Wells Fargo makes up for some of those fee differences is all the way at the bottom where you see the security holdings. So where you see security holding commingled funds, that would be like a hedge fund. That's an open-ended vehicle. The private REITs, if those were still holdings, things that are custodied elsewhere, but they're mirroring on their statements. And then the closed-end funds, that would be the private equity and credit that has distributions and capital calls. That is a little bit nuanced to keep track of. So U.S. Bank would charge a little bit more to monitor those assets. Wells Fargo wouldn't charge anything. And then Wilmington Trust would also have a fee to monitor or report on those assets in their statements. But if you look on the next page, on page 30, the takeaway here, and we'll just go to the bottom row here, and where you see the total fees, that first darker line. So all in with the 3 funds, U.S. Bank would be about $68,300. Now that's a little on the low side. They do have a minimum account fee. So for the LOSAP, it would probably be about $2,500 higher. So they would be pretty much in line where Wells Fargo is. And then all the way to the right, you see Wilmington Trust would come in about $10,000 lower than the other 2. So from the SORP perspective, I had it on a previous page, but just to give you a sense, the annual sort of estimated fee is about $42,250. So for these fees, it would really be on a percentage basis. And if the SORP comprises about 50% of the assets, then you can think about the SORP's fees would be about half of this. So for U.S. Bank and Wells Fargo, it'd be about $35,500. And then Wilmington Trust, call it, $36,50. So about $10,000 lower for the SORP fund. Based on these informal proposals. So if we look at the next page, on page 31, what we're putting forward from the board to consider today is just an approval to move forward with an RFP. The OPEB and LoSAP boards approved that earlier this month. If you all approve that, would be taken before the commissioners in July for their approval. August, September, later in Q3, we will work with staff, and we, meeting Marquette, will work with staff and procurement to develop the RFP and put it out. We'll get the responses, score them, and, have interviews as appropriate, not just with any technical evaluation committee, but probably important to bring anybody before the boards themselves. And then once the decision is made, have that transition be in Q1, whether it be, moving everybody under the Wells Fargo umbrella or everybody moving under a different umbrella. So with all that said, let me pause again for any questions or comments from the board.
So we could not go our own way. We have to go whichever way the other two groups want to go, or vice versa.
I would leave that for somebody else to answer.
So, and that was one of the purposes for the RFP for the investment manager also, was to try to have economies of scale and save some fees by commingling the funds. So yes, there's a great desire to find one custodian for the three funds.
Okay.
Administration purposes, and the size, I think we feel like we've outgrown Schwab, which is the provider for OPEB and LoSAP. And
Yes.
So looking back on your page 29, in the annual account fee line, second one down under Wells Fargo,
Yes, sir.
does this explain why every time we had a report, there was the account number showing as the last four digits, like we would put the last four digits of our Social Security number in, and they were all different? Were they harvesting $2,000 per line from us?
Oh, you mean on the previous report, the previous advisor's report where
Yeah.
there was 70 rows?
Uh-huh.
So what I believe, and I don't know this for certain since we're not the previous advisor, but so remember those three separate account managers that were liquidated earlier this year? It was the Kane Anderson, the Kane BR. The third one is escaping me, but that technically would have been another account being held because those managers are managing securities within their own specific account. So I think instead of being 70, it would have been, at least at that point, 4 accounts.
Well, it's water over the dam, but I never could understand why every line item, every investment had its XX, XXX, and then 4 digits, and they were all different as the account number at Wells.
I don't know the answer for certain. I've admittedly never seen anything like that before. I think that might have been more of an internal Morgan Stanley type of nomenclature, but if I'm wrong, I know that those 3 funds earlier had their own accounts. So yes, it would have been not just the 1, but it would have been the 4. But now, since we've gotten away from that, we will only have the 1 account.
Okay.
Yeah.
And this last comment is not directed at you. You didn't do this. But when the RFP goes out and the results are analyzed, I would very much like the results to come to the trustees before they go straight to the commissioners for signature. I think we need to know what is being signed off on and agree with it. I'm not saying we need to be the signatories, but I think it was kind of a mistake not to run the results of the RFP through the various boards, because those boards have the responsibility for the decision. So there was a recommendation from procurement, and that's fine, but don't leapfrog it straight to the commissioners for action.
I'm going to have to check the procurement policy, because we have to follow the county's procurement policy, and I don't know that the boards would have a decision-making role. I think the technical evaluation committee does, and the procurement manager. But
Well, it makes no sense. If we're sitting here wearing, as our attorney says, putting on our fiduciary hats, and then for us not to be in the loop, that's not right.
your argument, which I completely see, is, and at St. Mary's, we're concerned about saving money with all three of them, but your point is you're not going to save money for LoSAP by sticking it to us and making us pay more, that we should still have the best. As a board, it's our duty to say we want the one that costs the least and provides the best.
It's our duty to want whatever.
Right.
We might not even agree with the recommendation coming from procurement.
Right.
So if, as you say, and I'm not doubting your statement, but if that's what's baked into the procurement manual, I think that's a flaw, a big flaw, and needs to be rewritten.
That's something I'll have to look at. We'll have to.
Well, and we had long discussions about should these procurements even follow the county procurement process?
Right.
Should they be outside of it? And we obtained Mary Claire's advice, and that they should absolutely follow the county procurement process, because yes, boards have a fiduciary duty, but so do the commissioners, and the funds are funded by county public money.
Right.
So we have to follow the county public procurement process.
Well, I still think it's flawed, because if lawsuits start flinging around, we're going to be named long before the commissioners are for screwing this up.
But doesn't the technical evaluation committee have people from every
From
board?
members.
So we're covered there. It's like,
Right.
because we worked with our major to look at some of those and evaluate them.
Right.
Yep, we did. We
So
had-
we
that's
have
fine.
representation,
Right.
and those representations of all the data that gets put together in the final report comes from a conglomerate of the three boards.
And I agree with that. So there were representatives to that mix, and collectively, they came to a single recommendation.
Right.
Not in concert with each other, but as an average of all the scores put together, so that we
Right.
couldn't actually collude for some reason, right? It was kind of kept individualized.
Right.
Right. Yes, the
The technical committee actually reviewed it, and they each individually scored.
Right, you score individually, you don't score as a group.
Right.
Correct.
But out of that came a front runner,
Yes.
okay? And then the procurement officer is sitting here in front of us, telling us what the results were, and I'm going to quote him now, and those papers are in the hands of the commissioners for signature even as we speak.
Right.
That's not right. I don't care what the policy says, the policy needs to be fixed so that this board is part of the process. Otherwise,
What would
we
that
don't.
process be, though? What would this board do if we've already
The
been
board would
involved in
be,
the beginning?
But are we purely like advisors to the commissioners? The commissioners are the ones truly making the decision.
Well, they're not making
Well,
decisions
they're not making
on
these
this.
decisions on these items, correct. But as far as county funds, public funds, as they are responsible for the budget and the overall.
So any plan amendment has to be approved by them. Any plan amendment has to goes to them for final approval.
Right.
We make the recommendation, it gets put on a green sheet and comes over to the commissioners for final approval. I would recommend, and much to Mr. Walters' point, I do agree, I see that as somewhat as a flaw, that the boards do not have, the trustees of the boards that were not part of the technical evaluation committee should be able to review them and provide at least concurrence or state their objections on the record.
A recommendation.
Yeah.
Yeah,
I see his
see what-
point. I think it's
Reviewed prior to.
yes.
correct, yeah.
Thank you for
we're part-
saying
yeah,
it.
we're part of the
Thank you for
system.
saying it better than I stated it. But you're exactly right.
Yeah.
And if that means we have to amend a policy somewhere, then let's get on with the amendment.
easier said than done, right?
Well, we can take a look at it offline and discuss with procurement. and
But at the
figure-
end of the day, the commissioners are on the hook for approving it. I think based on what comes out of procurement office. And we could add, recommendation, maybe, we can look at it.
Yeah, we'll look
Well,
at
and we
it.
have to be cautious, right, because some of the material is proprietary.
Right.
So you have to be careful about who has access to it.
Exactly.
So we need to look at it.
Sure.
And we also need to look at the role of the Board of Trustees, right? The documents that outline what our role is.
So maybe
Yeah.
talk to Mary Claire.
Yep, I can bring that back.
There's plenty of time.
So we're going to think on this. All right, that's good.
But in the meantime, would the board, does the board endorse beginning an RFP process, or do you want to work on these things first?
Well, I'm certainly not happy with the current custodian, so my inclination is yes.
I concur. We've been with them for more than 5 years, and I think
Right.
a year ago, we started, pre-pandemic, started to discuss an RFP for Wells Fargo, and then we went through what we went through with them. They changed to Pinnacle and all that stuff. so-
Principal, right?
Principal, sorry, yeah. So I've long supported an RFP for Wells Fargo.
All right, then I'll move that we take the first steps to get an RFP out for a common custodian.
I second.
We have a first and second. Is there any discussion? If not, all in favor, vote aye.
Aye.
Ayes have it, motion carries. Thank you, thank you. And that would bring us to the end of Mr. Wing's presentation and to the committee reports of Ms. Karen Gates.
Okay, we had 3 invoices for payment for this meeting, 2 from Whiteford, Taylor, and Preston, and 1 from Bolton. The first invoice from Whiteford, Taylor, and Preston was for consulting services through April 30th of 2021 in the amount of $2,175. And I've included the backup, a detailed breakdown of the invoice for your review. The second invoice from Whiteford, Taylor, and Preston was for consulting services through the end of May 2021 in the amount of $787.50. And then we had an invoice from Bolton for $1,102. $1,012. Part of that invoice was for a retirement calculation in the amount of $262. And then Bolton calculated payment projections in order for Marquette for the asset liability study. And that was for $750. So the total amount for this report is $3,974.50.
Move to approve the administrator's report dated June 24, 2021, as presented.
I'll second.
We have a first and a second. All in favor, say aye.
Aye.
Aye. Any nays? Ayes have it. And that would bring us, is that the end of the committee report? Ms. Gates?
Yes.
Is that thank you.
Yes.
And that would bring us to public comments. Are there any public comments? No, there is not. Okay, moving on to item number 6. I would entertain a motion.
I move to adjourn the meeting?
Nope.
No. I moved to
Closed
go with
session.
the-
Oh, sorry.
Sorry, yeah. We reversed 6 and 7 at the beginning.
Sorry for my
That's okay.
tardiness,
That's okay.
Chairman.
I'll make a motion to move into the closed session at this time.
We have a motion.
I'll second.
All in favor, say aye.
Aye.
Ayes have it, motion carries.